My last video, I mentioned that there are quite a number of US technology stocks that are looking pretty undervalued and compelling buys right now after the sell-off in the Nasdaq. Well, some Chinese technology stocks are looking even cheaper. For example, Alibaba, JD.com. So do they make compelling buys right now in the market? Let's take a closer look. So this is the Seng Technology Index. It represents the majority of Chinese technology companies listed on the Hong Kong exchange. And you can see that after a very strong bull market last year, it's now gone through a sharp correction this year. It's down like 29% from its highs. So as an investor, a value investor, I get very excited when I see this because we make a lot of money by buying quality companies at huge discounts. We are greedy when others are fearful. So why has it gone through this sharp correction? Two reasons. The first reason is the same reason why the US has gone through a correction this year, because of the fear of inflation, rising bond yields, fear of rising interest rates, the same old yada yada crap, right? So because of that fear, it's come down. That's one reason. But the second bigger reason the technology sector has really come down a lot harder than the overall market is because of the Chinese government crackdown on monopolistic practices of Chinese technology companies. So basically the Chinese government was saying, hey, Alibaba, Tencent, JD, Meituan, these Chinese tech companies, they are behaving in a monopolistic way, right? Basically killing off competition. So the government came down to do investigation, fining them. And because of this fear of the government's regulation, it has caused panic selling and a huge correction in Chinese technology companies. So is this something that really concerns me? Because I own Alibaba as well. I own Tencent. I own a lot of Chinese tech companies. Does this concern me? No, it does not. Why? Because in the short term, these companies have to pay fines and be regulated. But I think in the long run, it is healthy for the overall technology sector for there to be fair competition. So I think that the market is just overreacting to a short-term problem. And again, whenever the market overreacts and misprices good companies at big discounts, that gives us investors an opportunity to make money if we understand how much the companies are really worth. Now, one of the things you have to understand about investing in China versus the US, by the way, I invest in both. I invest roughly about 70% of my portfolio in the US and 30% in China and Asia, right? So you could understand that Chinese markets are a lot more volatile than US markets, a lot more volatile. Why? Because in the US, the majority of investors are institutions, whereas in China, the majority of people buying and selling are not institutions, they are retail investors, the man on the street. So many of these people, they are not trained in finance, they don't understand fundamental analysis. They are basically all gamblers. They buy and sell on emotions and luck and feng shui. And I think it's going up. Let me buy the stock now. Oh my God, it's going down. Let me sell. Oh my God. So, Chinese are all bloody gamblers, right? Now, I'm a Singaporean Chinese, but for some reason, that gambling instinct never came into my genealogy. But understand, most of my Chinese friends are freaking gamblers. So because of that, you can see that you have got these huge swings in Chinese markets. Whoa, boom! So again, instead of fearing it, take advantage of it by buying quality companies when they're irrationally underpriced. And I think it's happening now again. So let's look at Alibaba, for example, because I know a lot of you have been asking me in the comments that, hey, Adam, do you think Alibaba is still a hold? Is it a buy? Should I sell? So let me talk about Alibaba, right? Yes, I'm still holding Alibaba. I bought it a long time ago, and I've been holding it for quite a number of years. And yes, I'm also adding more right now. So let's look at Alibaba. Now, first of all, let me show you the charts over here, right? Now, Alibaba is listed both on the Hong Kong market under 9988 ticker symbol and the US markets ticker symbol BABA. Between the two, I buy the one in Hong Kong because I find it's a bit safer. There's always a threat that that the US listed Alibaba may be forced to delist by the US government, which, no one can tell if it's going to happen, but to be safe, I rather buy the Hong Kong listed stock, right? But I'm going to use the charts of the US listed stock because it's got a longer history in terms of the chart patterns. Okay, all right. So this Alibaba, and first of all, if you look at the short-term time frame, it looks really bearish, right? So Alibaba was, doing really well, going up very nicely, and then what happened over here? We had the Chinese government cracking down on their monopolistic practices because that the founder, Jack Ma, couldn't keep his freaking mouth shut. He criticized the Chinese government, he pissed them off, so they came in and they regulated the company, they fined the company, and since then, the stock has been on a downtrend. Okay, so you can see it's a very clear downtrend. Downtrend is like wave up, wave down. So it's been on this downtrend, and right now it's right here at the low of this downtrend right now. So short term, it is still going down, right? Now, the funny thing is that a couple of weeks ago, the government more or less concluded their investigation to Alibaba. They said, okay, don't do this, don't do that, stop monopolizing, and they are complying. And they fined Alibaba. The fine was about 2.8 billion US dollar fine. Okay, so am I concerned with this fine? Not really, right? Because it's a one-off fine, and once they pay it, it's over, back to business. So more or less, I think it's now back to business. The majority of the scrutiny has taken place, and they just paid a fine, right? Now, in terms of the number of shares, Alibaba has about 2.7 billion shares outstanding. So if you take the $2.8 billion fine, divide it by the number of shares, that will equal to roughly $1.03 per share loss, right? In other words, the fine is equivalent to losing $1 per share, okay? But you can see the market has overreacted and the price has dropped like 35% from the high of about $319 to all the way to $206, right? So again, the market tends to overreact, but that's good for us as investors. We take advantage of this short-term panic. We buy it if we think that it's worth a lot more. Now, yesterday, Alibaba just announced their latest results, their financial year results, and here are some of the highlights. Now, did I like the results? Yeah, I pretty much like the results, but after the results were released, the price crashed even more, down 6%, which I think it's irrational, right? I don't think it makes sense, but I mean, good for me, right? I get to buy it cheaper. So let's look at the highlights. First of all, their revenue. They just reported revenue has increased 64% year on year. That's amazing. That's higher than Amazon's growth, higher than Apple's growth, higher than Alphabet, higher than Facebook. So in terms of growth, it's growing faster than all the US technology companies, right? Now, this excludes the consolidation of Sun Art because recently Alibaba acquired Sun Art, the largest hypermart company in China. It's kind of like a Costco in China. They acquired the whole company right now. If you exclude that, it's still a 40% year-on-year growth in revenue, which again is on par with our US technology companies. What I also like is that the number of annual active consumers on their China retail marketplace was 811 million annual active consumers. That's up 32 million from the same period last year. So can you imagine 811 million people buy stuff on Alibaba's platforms? That's really huge, right? In terms of mobile monthly active users, which means the number of people using their mobile app every month has reached 925 million people. That's almost 1 billion Chinese people using the Alibaba app. Put this in context. Do you know how many monthly active users Amazon has? Now, Amazon's a global company. They sell to the whole world, right? Amazon's monthly active users is 192 million people, okay? And versus 900 million people for Alibaba. So if you think about it, the number of customers that Alibaba has using their app is more than 4 times that of Amazon worldwide. That's how big Alibaba is. Now, the only negative thing that they reported was they lost money for the first time in 10 years. They had a quarterly loss. Now, why did they have a quarterly loss? Because of the fine. Because they were fined $2.8 billion by the government. So because of that fine, it ended with a loss. Now, do I care about that? Do I care about the loss? No. In fact, when you value a company, you exclude these exceptional one-off items because they won't get fined every year. So if you exclude the fine, they actually grew their profits by 18% year over year, which is pretty much in line with my expectations. Now, I'm not too concerned with net profit. I'm more concerned with the cash flow from operations and their free cash flow. How much cash they actually generate, because net profit is an accounting number that can be manipulated where depreciation and capital expenditures can kind of like distort it. But free cash flow is the true measure of the company's ability to make money, right? Free cash flow. And Alibaba's free cash flow increased 32% year on year. 32%. Now that's way above my expectations. In fact, last year, or rather in December last year, when I valued Alibaba, it was based on a cash flow growth rate of optimistically 21%. All right. So they generated 32% growth rate, way above my expectations. All right. So based on these numbers, I've done a new valuation of Alibaba, and again, I'm being really very conservative, and these are what the numbers look like. All right, so to value the company, I'm using a 20-year discounted cash flow, which means I'm assuming the company will only last for 20 years, which is really conservative because most analysts, they assume the company would last forever, and they project the cash flow to perpetuity using a terminal value, but I'm only using a 20-year cash flow projection. Okay, so the most recent free cash flow, as reported, 172 billion yen. All right, and the total debt of the company, 149 billion yen. Total cash and short-term investments, 473 billion yen. Right now, again, they are growing their cash flow at 32%, but I am only putting an 18% growth. Again, more conservative, and I've gotten this from various websites, analyst projections, getting 18%, and I assume it's going to fall to 15% and finally to 7% as the growth slows down. So being really conservative, using an extra high discount rate. Okay, so based on this, the intrinsic value of Alibaba stock is 1,973 renminbi or Chinese yen. So if you convert it to US dollar, that's $315 US per share, conservatively. So right now the share price is selling at, let's check it out, as of yesterday, share price at 206. So if you put in 206, boom, you can see it's selling now at a 34% discount. So you can see that it's even cheaper than some of the US technology companies, which I mentioned were cheap yesterday, right? So what's interesting is that after they announced their results with, tremendous growth in revenue and cash flow, the share price still dropped 6%. Why? Why did the price drop when they did so well? Well, it is something the CEO said. And what the CEO said was that for the next few years, they intend to reinvest a lot of their profits into growing their business. So they're going to spend a lot on capital expenditure. So people are concerned that that would lead to a fall in profits in the short term and a fall in profit margins. So in other words, the company is sacrificing short-term profits for long-term market share gains. Now, do I like that? Yes. This is exactly what Amazon did. Exactly. Now, if you remember the last couple of years, Amazon actually reported very low profits. The reason is because Jeff Bezos decided to keep reinvesting in new technology and investing in acquisitions and acquiring more market share. So that caused short-term falls in the profits. But because of that, in the long run, Amazon has become even more dominant. Because of that, I see the sell-off, that 7% drop yesterday, as being pretty irrational. Now again, so fundamentally it looks really cheap, right? But we have to look at the charts. Let's look at the technical analysis to intelligently think, okay, where can we time our entries? Again, if you look at the short-term daily charts, it still looks pretty bearish. You can see this is a very clear uptrend when the 50 moving average is above the 150 moving average and the price above the 200 moving average sloping up. That's a clear uptrend. But right now you can see that it is still on a downtrend. As long as the 50 moving average is below the 150, that is the technical downtrend. And as long as the price is below the 200 moving average, the red line, and the red line is sloping down, that downtrend is pretty much still in force. So there are many ways to play this, right? So if you're someone who wants to wait for bullish momentum, then you could wait for at least the price to reverse back above the 200 moving average, the red line. But the problem is by the time it happens, it would already have gone up quite a bit. So if you are taking a longer term perspective, you don't have to wait for a confirmed change in trend on the shorter term time frames. You can actually look at a longer term time frame and enter near a support level. And that's what I've been doing actually. So if you look at the weekly candles, let's look at the weekly candles, longer time frame. All right, what do you see on the longer term time frame? You would see that this is the trend, and it's got a pretty strong support at the green line, the 150 moving average on weekly candles. And you can see this pretty clear wave pattern, right? Wave up, wave down, hitting the support, bouncing back, hitting the support, bouncing, hitting the support, bouncing. And again, now coming back down, it is now nearing that green line, that 150 support at 203. So we are really close. So so right here, right now, sure, you could add shares. I'm already adding shares. But if we have a very strong candlestick pattern on the weekly candles, like again, a bullish engulfing or pin bar, that would be a very bullish signal to send the price all the way back up. All right, so that's Alibaba, right? Now, Alibaba is not the only one. There are many other Chinese tech companies that are great and are really underpriced right now. Another one is JD.com. Right, JD.com, which is a competitor of Alibaba. The intrinsic value I calculated is roughly about $100, and right now it's selling at $67. It's 30% undervalued. So again, quite a number of Chinese tech companies are looking pretty attractive right now. If you don't know which Chinese tech company to buy, is Alibaba or Tencent or Meituan, quite a number of them, you could simply buy an ETF that tracks all the Chinese tech companies. And there are quite a number of them. One of them, which I've been buying recently, is this ETF known as the iShares Hang Seng Technology ETF, ticker symbol 3067. Yeah, this is the one, right? This is the ETF that tracks the Hang Seng index run by BlackRock, iShares, right? So again, you can see again that really strong bull market, and we have this really sharp correction all the way back down to basically where it started, right? So again, you could wait for a bounce, and when it does bounce, tremendous upside for the Chinese technology stocks on the way back up. In summary, Chinese technology stocks look like a juicy bargain. They look even more attractive than the US technology companies. But there is a risk. And the main risk in investing in Chinese technology companies is the Chinese government, the Chinese Communist Party. Remember, the Chinese government has absolute power, and they can create regulation that can kill the company if they step on their toes. I mean, if Jack Ma opens his stupid mouth and says something stupid again, the Chinese government may crush Alibaba, right? So that's the risk, right? So it's kind of like you want to date, to date someone, right? And you've got this Chinese girl and you've got this American girl, right? And the great thing is that the Chinese girl is a very simple person, right? She doesn't mind going out with you to McDonald's. So it only costs $20 for a date, right? So looks really attractive, juicy bargain. Whereas the American girl, maybe she's more high class, she wants to eat in a fancy restaurant, so it may cost you $200 for a date, right? So which girl do you go for, right? So sure, you may say, I want to go for the Chinese girl because, cheaper date, I get it at a discount, but there's a catch. The catch is that Chinese girl has a crazy father who could burst into the room anytime and chop off your dick. So the best thing to do is to diversify. Don't put all your eggs in one basket, although I love Chinese technology companies, but I ensure that I'm diversified. I've got US technology, Chinese technology, and I spread out my risk. So if the Chinese father comes in with that chopper, I'm out of there and I've got another date waiting outside. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.